Hey there, it is Mike Wise, CMG Home Loans with your weekly mortgage update. Big week next week. The Fed is meeting. That is when they're going to talk about lowering the Fed funds rate for the first time in quite some time. And so hopefully we'll see that. We think the number is going to be 25 basis points lower, but we'll see. So the BLS, the jobs reports came in a little bit lower. The yield curve, it uninverted. Inflation came in pretty much where they expected it to be, and then we'll go into some of the homeowners' equity, which is going up here. But let's start with the 10-year versus the 2-year Treasury yield. This is a nerdy chart, so you don't have to listen to this if you don't want to. Skip forward a little bit. But these red spots are when the yield curve inverted. And then you can see over here to the far right a little bit of green, and that this week that means that the yield curve uninverted. That means that the 2-year Treasury rates are lower than the 10-year Treasury rates, and when it's inverted, the 10-year is lower than the 2-year, and that is not a good sign. You can see all the green on this chart. In normal situations, the 10-year is a much higher yield than the 2-year yield. So what I want to point out on here is basically after it uninverts, we go into a recession. So these gray lines going up and down here, those are recessions that happened, right? And so you can see that every time it uninverts, you go into a recession. And these are some of the examples up here of when we did go into recessions after the yield curve uninverted. So question is, are we going to get a soft landing or not and stay out of a recession, or are we currently in one or going into a recession? So only time will tell on that. So why is that important? Well, if we take a look at the history of the Fed rate cuts. So from the peak, historically, on average, the 10-year falls 1.4% from the peak right at the first cut. So since the first cut, right? So in October of 2023, we hit the peak of 5% on the Fed funds rate. And we're currently at 3.66, 3.7%. That's 1.3, almost 1.4% spot on when the Fed is actually going to make their first rate cut. Now, let's go a little bit further on this. Historically, on the 10-year, it falls another 1.5% from the first rate cut to the low. So that means that from next week when the Fed meets, it's going to drop another 1.5% from that level. That's what history tells us, right? And so if we're at 3.7%, we go down another 1.5%. We're going to be at 2.2% on the yield. That puts mortgage rates sub 5 for sure, 4.5 to 5% on a 30-year fixed rate mortgage. Not saying that's going to happen, but it is historical data that shows us that, right? So you can look at some of the charts here. That shows you the Fed funds dropping after that first rate cut. So this line here is kind of where we're at right now. But if you can see that after that first cut, things kind of go down. That's why they try and spur the economy with the lower Fed funds rate. Consumer Price Index came in just pretty much on pat here. But what's holding us back is these 3 items again. I know I've showed you this a lot, but shelter or the rents, basically they were unchanged, and owner's equivalent rents were up slightly, but those are the kind of the things that are holding us back. Motor vehicle insurance, it's up 18.6% year over year, so almost 20%. And then everything else on the inflation is only at 0.19%. So it is a really, really low. There's only a few things that are holding us back, which is the shelter, rent, owner's equivalent rent, and motor vehicle insurance. So those things, and shelter makes up a big, big piece of the Consumer Price Index. So inflation pretty much coming in at normal. A couple of updates here. This went way down. So September 18th, 100% that they're going to have a drop.
the probability of a 50 basis point cut went down to 15%. So that was way down from 39% last week. And then it's still pretty much the same that we're going to have 100% rate cuts, and it looks in November and December. And we think that they're going to go down by 75 to 100 basis points from today. So that means 3 more meetings. That means that at least at one of those meetings, there could be a 50 basis point rate cut. So that's what the market is telling us, and that's where we think that we're headed on this. So what's happened in the treasuries this week? Basically, we went back up all the way up to 101.5. Remember, higher prices mean lower interest rates. And so it's butting up against this resistance level of 101.5, and it's gonna, hopefully we'll break through that and get a little bit better interest rates. The same thing is happening on the yield, right? And so down here, if you can look at the last 4 days, they've been kind of flirting with the support level at 3.663. There, and they're trying to break through. There's not a whole lot of numbers that are coming out today, so I don't think that we're going to see too much lower of rates at this point in time. But they're trying to break through on that. But look at the charts. It's going down significantly. Back on July 1st, we were all the way up to 4.5%. So we've dropped 1% since July 1st. So July, August, we're in September now. So 2.5 months, it's dropped a lot, and interest rates are going down. So mortgage rates, they've hit 6.15. They're up just a little bit this morning, but definitely lower than they were last week as a result of it. Homeowners equity, basically, there's a lot of equity in houses right now. So year over year change is up 8%, or 1.3 trillion in increases in equity. So that puts us at a total of $17.6 trillion. If you take the average homeowner, it's about $315,000 in equity. And if you need money out of your house, that gives you about another $200,000 to tap into that with a cash out refinance or a home equity line of credit. So negative equity was only on about 960,000 homes. So that's a very, very small portion of the market right now. That at one point in time, back in 2007 and 8, it was up to 20% probably of the homes with a mortgage that had a negative equity. So a lot has changed since the 2007-8 timeframe. Let's see here, and then the top 10 metro areas, July 24 versus July 23. Couple of shout outs here to Los Angeles, San Diego. Looks like New York is not on the list here, so we're not seeing New York, but a lot of growth in these top 10 metro areas. Las Vegas, Chicago, Miami, all seeing some growth there. For comparison's sake, we've got the 6.11. We're at 6.15 at least this morning, if not a tad bit higher than that. But remember those highs of 8% back in October of 2023, and a year ago we were at 7.25%. So we're 100 basis points lower than we were a year ago. So very, very good news. Wanted to make sure that I tell you about this special. You got to call me. We've got a buy down special that's a lender paid buy down that can help you get a lower interest rate for the first year. So give me a call, no cost to you, and we can get this going. Hope all is well. Hope you have a good weekend. I will be around, and if you have any questions, please let me know. Have a good one.